everybody, this is Jason Matthews with Matthews Financial Insurance Solutions. Every month, as you guys know, we do our market recap on what happened the previous month, where we see things are headed to. And so we really want to give this information to you guys this year as a goal. Me and my team, my staff, where we really want to work hard so you can be informed about what's happening in the world, not just what you see on the news, but actually understand everything that's happening so you can make the best decisions for you, your family, and your community. So I'm really excited about this month. First of all, September is a recap. So September, my birthday month. So thanks again for everybody who gave me a birthday shout out. Thank you again. I know I've been busy and haven't reached out to everybody on the Facebook world or YouTube or text, but thank you guys again for it. It's been such a busy month with all this economic news. If I haven't reached out to you, like I said, I do apologize for that. So before we really jump into this, let me go ahead and get this ball. I'm about to get my screen ready and get this ball rolling so we can really get going on this recap. So once again, if you guys have this information, if you think this is great, do you get something out of it, please share it with the world as we try and get more information from this. Also, later on, this will be on our YouTube channel as well. If you have not, make sure you subscribe to Jason Matthews on YouTube, as we are definitely trying to get the word out, as we try and educate the people, as I think is more important than ever. We are truly in the age of self-reliance, like I wrote in 2018. So let's go ahead and get this ball rolling. Let me share my screen. So once again, you guys all know who I am, Jason Matthews. So let's start off every month. I start off with the stock market recap, where we really talk about, and I really dive into what has happened in the previous month in the stock market. So with the stock market, there are three major indexes that we look at. One is the S&P 500. And just a reminder, the S&P 500 are the 500 biggest publicly owned companies in the country. So in the month of September, the S&P 500 went down 9.34%. Dow Jones average, the Dow Jones composite, the top big 30 companies, it went down negative 8.84, and then Nasdaq, which is how we measure the tech companies, it was negative 10.5%. So in September, the S&P, the Dow Jones, it had the biggest one-month drop that we have seen since March of 2020, and it actually been the worst performance since September of 2002. So this September, or this last September, was the worst stock market we have ever seen in the stock market. So here it gives you guys a better graph: negative 9.34, negative 8.84, and negative 10.5%. So let's look at a couple of things that happened. So going back to 1920, the S&P has dropped 7 times or more, at least 11 times. Likewise, the Dow has declined by 7% or more, 13 times going back to 1928. And with the tech-heavy Nasdaq, we only need to go back to 1986 to see 6 times it has declined by 9% or more. So according to data by the Stock Traders Almanac spanning back to 1950, last September, was the worst September ever for performing for the S&P 500 and Dow Jones average, the worst since the 1971, and even for the Nasdaq back in 1971. So this stock market in the month of September was the worst we have ever seen in the month of September. And historically wise, October is when we see a lot of crazy things happening in the stock market. As you guys remember, 87, 2008, just remind you guys of those periods of time we have. And I remember 08, and I remember that time of 08 when we felt the stock market during the housing bubble when the price dropped. But let's get a little bit positive right now. So here's the positive. So we look at the data back in 1950. There was 3 years following a 20+ decline in the S&P. The index saw an average gain of 29%. So yes, the market might go down 20%, but then it bounced back to 29% across the broader market. Stocks have increased 26% within 2 years of the 20% drop, according to Keith Leonard, chief marketing strategist at Truist. Of course, let's just say this: past results don't dictate future performance. But let's break this down. So historic-wise, when we've seen a drop of 20% or less in what we call a bear market, eventually within a 2-year period, the market does roar back up. But I think right now we're in times that we haven't seen, because the people who are dictating all the money, the Federal Reserve are really trying to shrink the money supply and raise interest rates. And interest rates are the number one dictator in the world. And not just them trying to raise rates, we see across the whole world as Japan now starting to see inflation, and then us have it in Europe. So everybody's in the world of period of inflation. And right now, what we see is that America, I went to Huntington Beach earlier this month, but like they said, America is the cleanest shirt and dirty clothes hamper right now when it comes to inflation. So let's look at jobs and unemployment. So non-farm payroll employment rose by 315,000 in August. That is the latest data until September numbers come out on October 9th. So right now, our unemployment rate is 3.7% is our unemployment rate, which means it is creeping up slowly from the previous months, which the Federal Reserve wants. So August unemployment numbers was 3.7%, which are really historically low. Everybody can work if they want to, but the feds have said that they want unemployment to go up. So we should know these numbers will go up in the future. Now, how far in the future they will go up, I'm not sure, but the Federal Reserve want these numbers to go up. The reason they want that is this: if we're at full employment, that means incomes will rise. If income will rise at that point, which means that the business owners and businesses will raise the prices on their goods and the services even higher, so it's going to be more expensive for those goods. So because of the lack of workforce, I can demand more from that job because they don't have a workforce. So that's why they want unemployment to be higher. So at that point, you won't be begging for more money. I know this sounds very bad, but that's the reason why they're expecting that. So let's look at GDP, gross domestic product. This is what most people look at. So, and when you look at the GDP, quarter two, the GDP fell 0.6%. Quarter one, GDP dipped 1.6%. Historically wise, when we have two negative quarters of GDP, that means we're in recession. When I was at Huntington Beach, shout out to Pacific Life, I went to the thing, they had one of their economists, had an economist there. He says, it's not just GDP that dictates if we're in recession or not. There are other things that dictate it. So right now, based off the analysis that the Feds put together, no, we're not in a recession based off of their standards. It's more than GDP. But I know in the news, he said we always hear GDP, but it's way more things that come in that's baked into it to really consider that we're in recession. And he said right now we are not in a recession. Now, could we be in a recession in the future? Yes. We're hearing more and more people are thinking that we're going to be a recession in 2023. So let's go now to the number one word that everybody has questions about, which is inflation. So when we look at the annual inflation rate for August, it was at 8.3%, only a slight drop from July at 8.5%, and then June's peak of 9.1%, which are still the highest marks that we have seen in 40 years, but we have seen it slowly decreasing. Now, the consumer price index increased by 0.1% in August compared to July. Despite falling gas prices, sharp increases for food, shelter, and Medicare has pushed it up. Let me say this. So in here in California, we're seeing gas prices jump right back up since the last inflation numbers. But where we see the drop off previously, where people had a slight break in it, where we do see it, that we saw increases was in food, as we have seen food prices have drastically increased when we go to the stores, grocery shopping, or at the restaurant. They have drastically went up. Also, medical care. I realized that our health insurance has went up 40%. I look at how much I'm paying for my company, how much we're paying for our health insurance is through the roof right now. I know a lot of Americans might not know if they work for a bigger company or a government agency, but healthcare has definitely went up. In fact, let me go deeper in this. Food prices in August went up 11.4%. Shelter costs went up 6.2%. Electricity, 15.8%. Used cars and trucks jumped 7.8% for the month. So here's what I'm going to tell you guys. Energy prices going to increase this winter. Is there something that's going to lower as well? We are not sure, but everybody's predicting due to Ukraine, the Europe issue, the cost of energy, oil, and everything else, we will see energy prices go up going this winter. To control inflation, though, we're going to have to hope there's something else subsidized that drastically drops. So I don't think we're going to go through 2022 without inflation. When I went to Huntington Beach, the head investment officer for Pacific Life, she believes that we're going to go through inflation through 2023. So this next year going to be more period of inflation that they're predicting there, and that's how their investment strategies are kicking in for that. And they have what, a $90 billion in assets, so, or 900 billion, something crazy, a lot of money in assets. So they're looking at that for as their investment strategies, how things are going to look. So also the personal consumer expenditure, the Fed's preferred measure of inflation climbed 0.3% in August, is now 6.2 compared to the same period last year as well. The next consumer price index going to be released on October 13th. So everywhere, pay attention. That will let us know how much more the Feds will raise rates. Are they going to raise it at 50 basis points, 75 basis points, or 100 basis points, or not at all? I think right now the vote is right now is going to be between 50 and 75 basis points. Okay. So let's say this: despite higher prices, higher interest rates of credit cards, mortgages, U.S. consumers still spending at a robust rate. In August, consumer spending increased by 0.4%. Here's the thing about this right now: credit card debt is crazy at an all-time high. So things are costing more of the essentials, and we're seeing people use more and more of their credit card debt for it. So let's look at that consumer debt. So right now, when we look at our debt for household debt and credit, the household consumer debt now is at 16.5 trillion, up 2% since QE, 2 trillion more than the pre-pandemic minimum. So people had their COVID, people paid off all their money from the COVID relief. Now people are racking up the debt past all the debt relief since COVID because it costs us so much. Credit card debt rose $46 billion in Q2 alone. Its alone is 5.5 month-over-month increase and 13% more than the same period in 2021, the biggest balance increase in 20 years. So how are people going through this inflation? So people are not just going through inflation by getting pay raises. A lot of people are not getting pay raises. So how are consumers surviving during this period of time? They're trying to maintain their lifestyle, but they're going further in debt to do that. Number one way right now is through credit card debt, right? So we're seeing that right now. There's over 500 million credit cards in the country. So there's 364 million people on this in the United States. Now you eliminate kids, that's about, say, eliminate kids, that's about 50 to 100 million. So out of that 300 million, about 200 million people have on average about 2.5, 3 credit cards per individual. Also, auto loan debt grew 33 billion Q2, the largest quarterly increase. So people are buying less cars, but the cost of cars have went up. So we see auto loan debt go up because people who are buying cars are paying a lot more for it as well. So in the mid-September meeting, the central bank increased the Fed fund rates by 75 basis points. This is the third straight meeting with the 75 basis points increase. The Fed fund rate now is between 3% and 3.25%, which is crazy, which is not crazy historically wise, but it's crazy as we finally got over a period of 0% interest rates. Now, in a survey by the 33 leading economists, 70% thought the Fed fund rate will see another 3/4 point increase in the November meeting, which will be the 4th straight month with that same increase, which is crazy. They also predict a 50 basis point increase for the Fed's December meeting, bringing the Fed fund rate between 4.25 and 4.5. This is going to be the biggest interest rate hike overall, as fast as we have ever seen in a long time. In fact, it might be most fastest ever that we have ever seen. The same poll think the Fed's fund rate will be in Q1 going to be 4.5 to 4.75%. Let's see this. We're going to see higher interest rates, which means our savings vehicles save money, or even bonds, those rates are going to go up. But we're going to see it going to keep going up, which is going to be good for savers. Now, people who are consumer, who are in debt, they're going to have to pay more for that loans and that debt that they do have. Now, let's talk about how mortgage and housing. Right now, the 30-year fixed home loan across the United States is 6.7%. Previously, unimaginable considering that rates were just 3% at the start of the year. So rates have more than doubled since the beginning of the year. Of course, this is leading to a monumental slowdown in home sales. I get Zillow every day. I get all these different websites for homes, and I'm seeing tons and tons of price drops, or I'm seeing houses that have been on the market over and over again. Also important to note that while we are likely to see a significant price drop in the end of 2020, 2023 is nothing to complete the market collapse of 2008. And I agree with this. And the reason why we say this is this: in 2008, the issue was that people had adjustable rate mortgages and they jacked went up. Now, most people have 30-year fixed mortgages. So that means their payments are going to stay the same no matter how much inflation hits. What's going to hurt people, though, is if we start seeing layoffs and people don't have enough money in savings to go through the weather of layoffs when they do happen, or if they're going through hiring freezes. And the reason why I say that is I'm hearing about hiring freezes at certain tech companies already. We're hearing about slow down the tech. They're getting hit the most in layoff. I think in the Bay Area, I think we might get hit harder than anywhere else because we're so saturated tech. There's so much business, there's so much money in tech, but right now it looks like we're taking the punch bowl away from it as well. So I think that's what we see a lot. And here's a good quote to end this out. The Fed reinforced their commitment to whatever it takes to get inflation under control, even if that means causing some pain in the economy, which is so, so true. And once again, thank you guys all for jumping on this. Once again, thank you for my team for helping putting this together. If you want this information, make sure you email us at matthewsfinancial@gmail.com. Give us a call, 510-229 7608. I think right now we're going to go through this period of inflation. There's going to be some pain in the economy. I think we've already seen pain in the stock market. We'll see pain in other aspects as well. I think the people who might over leverage themselves are going to be hit the worst during this period of inflation. Also, our people who are blue collar, working class folks will be hit the most as is. But inflation is a stealth tax. It's going to hit everybody in their own home. So make sure you are built for times like this. And if you guys need some advice, you guys want to put together some strategies because your portfolio is getting hit right now, your retirement plan is getting hit, you want to find out some things, let's make sure we talk. Hope everybody have a good day.